Okay, so what I'm going to explain to you real quick is an FHA loan without a down payment program applied to it. So the math I'm about to show you is before the down payment is applied to the program. So if the down payment program give you 3% or 6% or whatever your lender tell you that down payment program is going to give you in your percentage, then you just take the math that I'm about to show you and apply that percentage towards whatever what I'm telling you in the financing part fast. So we have FHA loan, 3.5% down. That's what you're going to put down because the loan is financed at 96.5. So that's the amount that's going to be financed. You're going to need to come up with that. That's going to take away from that total sales price that you're financing, so getting the home for. So you're going to come up with 3.5%. That's your down payment. $300,000 home. You're going to be coming up with $10,500 for your down payment. The rest of that, the 96.5, is going to be financed. And I could even go a little deeper, and I could write this on a contract so you can see how it's supposed to be written. But when I'm explaining to a client, I'm showing them all this math. Showing them all the math before we submit an offer. We even go to the extent of making sure that they see kind of an example of what their house payments is going to look like before they even sign on the contract. Because you don't want to have a shocker when you're under contract and you never knew what your house payment was going to be. I know a lot of people that told me stories about they didn't know what their house payment was going to be until they got to closing. It's like, what? So you're going to be looking at 3.5% down, $10,500 on a $300,000 home. This is an FHA loan. FHA loans are considered to be loans that have lower down payments, lower credit scores are allowed, and higher debt is allowed. So a lot of times these are considered as first-time home buyers because you're just getting going. Is it the best loan for you if you're a first-time home buyer? Might not be. There's other factors that go into that. If you have a great credit score and so forth, I'm going to go over those questions with you shortly because I'm going to show you different types of loans that may be better than the FHA loan. So you'll have closing costs. Closing costs is, how do my lender get paid? Or how does all these fees get paid at closing? This is where we go. So closing costs, I usually say to calculate 3 to 4% for closing costs. So on a $300,000 home, you're going to be looking at about $9,000 to $12,000 for the closing costs. So you're going to say $10,500 for your down payment, plus you're going to need about $9,000 to $12,000 for your closing costs. And what does your closing costs consist of? That money's going somewhere. Let's go over it. So your escrows. And an escrow it's an account that holds reserves of your property taxes, your home insurance, and a thing called a mortgage insurance. And for FHA, this protects FHA to make the loan possible to you. It keeps the financial loan available to people at a higher risk or people in the FHA pool because this loan was considered, if everyone is paying into that mortgage insurance, it's protecting FHA to be able to allow more loans if the buyer was to default on the loan because everyone's paying into a money pool and that money pool is getting big. And if you were to default, then FHA says to your lender, hey, we have a mortgage insurance premium that's going to make sure that that home is covered and you won't be at much risk. Hazard insurance, you'll see on your paperwork, hazard insurance protects your assets. And I always say, get 3 quotes from home insurance as well. 3 quotes is always a thing. I always go through everything, 3 quotes, 3 quotes, 3. If you want to get 4, 4. Okay, I always say get 3 because there's different types of businesses out there. So I would say get 1 with your car insurance company that you're currently with, that you get your vehicle insurance through. See what their quote is on your home. Let them know the sales price, the property address, and let them know what you want covered. You'll go over certain things with them, Make sure that, you know, if you're in a wind and storm area, you want to go over that. Your realtor should be able to let you know if you're in a wind and storm area. If the property is in a flood zone area, you want to check that as well. You can also research and look at maps online that shows if you're in a flood area. I'll put some down below. If you're in a flood area, the property insurance is going to be more, because now your lender is going to require you to have flood insurance, because that's another protection that they want to make sure the asset is protected, because this is your property and they want to make sure that that asset is protected, because that's what they're, you know, supposedly giving the loan on, but the loan is on you. The other item in closing costs is lender fees. So your lender gave you the loan, they were able to do everything, and this is things that you're going to compare in your price comparison as well, is lending fees. You just want, when you're doing your lending fees, you just want to look at everything that's being charged, you're being charged for. You may pay buy down points to get your interest rate lower. And then you have title policy insurance. And this is an insurance that I will also explain a little bit further. And this protects the chain of title. So if the property was built on land and it's a brand new property, then it's protecting everything through generations on the title being clear, free of debt, and that you're purchasing a property that have no kind of barriers of debt on it. So nobody come back and say, this was my land, which happens. So that protects you. And title insurance is very important to get. Your lender is going to make sure you get it for them. Title insurance also makes sure that they just make sure that everything is free and clear. Just remember that, free and clear of debt. So you're going to also have maybe debts to pay at closing. I had a client that had a credit card that needed paying at closing. And the good thing was they didn't have to come out of pocket, because I was able to negotiate their closing costs, and that closing cost considered their credit card in there. And so their credit card was also paid with the property, which was fantastic. So not only did they get a home, they also got their credit card paid off, which was something that the seller didn't know, but we had asked for the closing costs, and that closing cost was distributed how it needed to be, so that way they close on the home and get their keys. Because if that credit card wasn't paid, then they wouldn't have got the keys to the home. So there was barriers that needed to be done in order to get their keys to their home. So debts maybe need to be paid. Debts may be needed to be paid at closing, and those debts could also be paying down items. Or you may have a collection or something like that need to be paid. Because again, the title policy is making sure that debts are paid and that nobody have any type of liens. You also can't have any type of issues that's going to prevent you from buying or selling that property. So everything is protection, and this is all done through the title company. The title company balances out all of this at the final end. And then you're told exactly what you're going to be needing to bring to closing. That's pretty much it. If you have further questions, please feel free to reach out down below. No question's a dumb question. I love educating. And whenever I get with a client, I'm always going deep into this with them, so that way they know everything, because all this math and explanation is something that I get excited to explain, but every scenario is different. And usually when they tell me everything that I need to know through my questions session with them, then I'm like, okay, this is what your scenarios are going to look like. Once they get financed and we know what amount they're able to shop for, then I'm like, okay, this is what your scenarios is going to look like in these different types of situations. So if we're going to a new home lender versus a pre-existing home where someone have already lived in, let's say they want to look at the pre-existing home and the new home builder. I'm able to compare with them if their lender is not available. So we're able to go through those pros and cons, but also the pricing, what they'll be looking like on their down payment and so forth, and which choice is a better solution for them financially, also for the overall time of having their asset. I go into further in depth on this stuff, but this is something that I love doing. And like I say, no question is a dumb question. There is one thing that I'm usually always asked by first-time home buyers. And this is, like I say, no question is a dumb question, but I'm just going to let you know. And I'll put it here at the end of the video because I don't know if you were listening. So usually I'm asked, Cheryl, I see this $300,000 home. Can I get a loan for $350,000? Can I get a loan for $350,000? And I'm like, why would you need a loan for $350,000? Or you're only offering $300,000. Well, I was gonna use $50,000 to do upgrades or to go buy furniture, things that I need in the home. No. No, you cannot do that. So you're only gonna get the loan for your FHA loan. 203B is going to be, let's say a 203B, because there's a 203B is going to be for the sales price amount and the amount that the property is appraised for. Look forward to working with you, answering any questions. Feel free to contact anytime.